What's up, everybody? Welcome to another video on technical analysis in the J&J Futures Bootcamp. Today we're going to be discussing liquidity sweeps and inverse fair value gaps together, which can help you get really nice trades and big wins in the futures trading market. So when price goes and sweeps a liquidity point, which are the swing lows and highs that we've talked about previously, and then comes up and inverses a certain bullish or bearish fair value gap, which we just talked about in the last video, that is double confirmation that price is going to continue in that direction. So for example, you look at Jake's screen right now, the low that we marked out is a form of liquidity. It's a swing low, and we came down and we took out that low, which is a liquidity sweep. So now market makers and hedge funds probably want to drive price up, but we're not just going to enter immediately off that. What we also notice is a bearish fair value gap was formed on the way down there to sweep liquidity. So what happens? Price comes up and the body of a candle closes above that fair value gap, making it an inverse and essentially saying, okay, now price probably has momentum to continue to the upside. So now that we have a check mark next to the liquidity sweep, that will bring us to the upside, and we have a check mark next to an inverse to the upside, that is double confirmation that price is probably going to continue up, and that's when we will get our entry.
So this basic concept is the idea of trading and futures trading. You stack different concepts on top of each other to confirm your bias. So when we have a sweep of liquidity, that is one hint that we're going to move up. And when we conflate that with an iFVG and also another indication that we're going to move up or move down, then we have double confirmation that the price is going to move up.
Another example would be one that I got on the charts here myself. As you can see, this is a swing low, another point of liquidity. And price comes down, we take out that low, meaning a wick goes and takes it out, and we form this very small bearish fair value gap right here. So now we're waiting for a body to come and close above that fair value gap. Finally, that happens, and that gives us double confluences. Once again, like Jake said, we're stacking confluences together. We think price is going to go to the upside, so as soon as that body closes, we enter a trade and we bet on it going up. That's called the long position. So we get in longs and we target the next liquidity that we could find. So we have this very outstanding swing high point, which is a clear liquidity zone. And what happens? Price goes up, and what do you know? We sweep that as well, and then we get a little dip down, which we were able to avoid by taking all of our profits at that liquidity zone. So as we previously discussed, liquidity sweeps are usually bigger firms taking out retail traders and their orders. But as we also discussed, there's an imbalance of retail orders in fair value gaps. So if we're sweeping liquidity, we're taking out retail traders there, and then we're coming up and we're inversing an imbalance of orders, which means we're taking out more orders there. Now that we have so many orders in a market, someone or something has to conflict with those orders or match them, because that's how a market works, in order to drive price a certain direction. So these bigger firms like hedge funds and market makers will come up and they'll take all those orders and then reverse price, which is why it is such high probability for price to continue after sweeping a low or sweeping a high and then inversing a fair value gap in that direction, and that will usually cause price to continue to whatever side that we're supposed to go.
And like Jack said, we're not trying to fight these market makers, Goldman Sachs, all these hedge funds. We're not trying to fight them. We're trying to ride the wave, take a little piece of their pie, and basically follow what they're trying to make the market do.
Yeah, to conclude, liquidity sweeps and inverse fair value gaps are extremely key to our model. It is not the entirety of our model, and there's also a lot more that goes into it. As Jake said, we like to stack as many probabilities as we can, as many confluences as we can, and there's a lot more that go into every single trade that we take and a lot of different things that we look at. But liquidity sweeps and inverses are extremely important and a very solid base to our model and what we trade every single day.